September 16, 1992. I'm sitting in my office watching the British pound collapse in real time. We've just made $1 billion in a single day. My team is celebrating, but I feel nothing, not excitement, not relief, just this quiet certainty that what we saw coming finally arrived. The newspapers would later call it breaking the Bank of England. Politicians accused me of destroying their economy. But here's what's strange: I wasn't gambling. I wasn't even taking a risk, not really. I was simply recognizing something that everyone else was refusing to see. That day changed how the world saw currency trading, but for me, it confirmed something I'd known for decades about how markets actually work, and it has almost nothing to do with numbers. My name is George Soros, and over my career I've made and lost more money than most people will see in 10 lifetimes. But this isn't about money, it's about a way of thinking. For those unfamiliar with finance, think of markets like this. Imagine millions of people voting every second on what they think something is worth: a currency, a stock, a commodity. The price is just the average of all those votes. Simple, right? But here's the problem. People aren't voting based on reality. They're voting based on what they think everyone else thinks. And that creates something powerful and dangerous: patterns that feed on themselves until they can't anymore. This video answers one big question. How do you see what's actually happening when everyone around you is convinced of something else? How do you think clearly when billions of dollars are moving, emotions are high, and experts are telling you you're wrong? The answer isn't about being smarter. It's about having a mental framework that works when everything else fails. Let me start with the most important concept I ever developed. I call it reflexivity, and it's simpler than it sounds. Traditional economics says markets move toward equilibrium like a pendulum that eventually stops swinging. Buyers and sellers find the right price, and everything balances out. But this is where it gets interesting. I realized early in my career that this is completely backwards. Markets don't move toward balance, they move away from it. Here's a real example. In the 1980s, I watched the conglomerate boom happen. A company would buy another company, and Wall Street would get excited about synergies. The stock price would go up. With a higher stock price, the company could buy even more companies. More acquisitions meant more excitement, higher prices, more buying power. The trend was feeding itself. Everyone saw this happening, but most investors thought, this is the new equilibrium. This is how things work now. I saw something different, a loop that would eventually break because it was based on perception, not reality. When I shorted the conglomerate stocks in the late 1980s, people thought I was crazy. But here's what they missed. I wasn't predicting the future. I was recognizing an unsustainable pattern. The boom wasn't moving toward stability. It was accelerating away from it, which meant it had to reverse. The trade made hundreds of millions, not because I was brilliant, but because I understood that markets are driven by feedback loops, not rational equilibrium. This is reflexivity. Participant bias influences events, which then influence participant bias. It's a two-way street, and once you see it, you can't unsee it. Now here's something that will surprise you. I'm wrong constantly. In fact, I start every trade assuming I'm wrong. Most investors are terrified of being wrong. They do endless research trying to build certainty before making a move. And I understand that impulse. Nobody wants to lose money, but this creates a dangerous illusion. In 1987, I was convinced we were heading into a major market crash. I positioned my fund defensively. Then the market kept going up and up. I was losing money while everyone else was getting rich. What did I do? I admitted I was wrong and reversed my position. I went heavily long, betting the market would keep rising, and it did for a while. Then October came, and the market crashed exactly like I'd originally thought. Here's the key lesson. I made money both times, not because I predicted correctly, but because I stayed flexible. I had a hypothesis, tested it against reality, and changed my mind when the evidence changed. Most investors get emotionally attached to their ideas. They see contrary evidence as a personal attack. Their ego gets tangled up with their portfolio. This is where most people lose, not in the analysis, but in the attachment. I developed a simple practice. Every position I take, I immediately write down what would prove me wrong. Not might prove me wrong, what would prove me wrong. What data, what price movement, what event would tell me I've misread the situation. This isn't pessimism, it's realism. The market doesn't care about your thesis. It doesn't care how much research you did. It only cares what's actually happening. Let me walk you through how all this came together on the trade everyone asks about. In 1992, Britain was part of something called the exchange rate mechanism, essentially a promise to keep the British pound at a certain value compared to other European currencies. But there was a problem nobody wanted to admit. The British economy was weak, interest rates were hurting businesses, and maintaining that exchange rate was costing the government billions. I looked at the situation and saw a reflexive loop running in reverse. The weaker the economy got, the more pressure on the pound. The more pressure on the pound, the more money the government had to spend defending it. The more money they spent, the weaker their position became. But, and this is critical, I wasn't certain. What made me certain was watching how the government responded. They kept insisting everything was fine. Politicians made confident statements. The Bank of England raised interest rates to defend the currency. These weren't signs of strength, they were signs of desperation. They were running out of options. So I started building a short position, betting the pound would fall. My team was nervous. We were essentially betting against a G7 government with theoretically unlimited resources. One trader asked me, what if they don't give up? What if they keep defending it? I showed him the math. They can't, I said, not without destroying their own economy. Here's what people don't understand about that trade. It wasn't bold. It wasn't a gamble. By the time we made our full bet, the outcome was nearly certain. The government had already lost, they just hadn't admitted it yet. On September 16th, they finally broke. They withdrew from the exchange rate mechanism. The pound fell 15%. In a single day, our position made over $1 billion. The newspapers called it an attack. Politicians called it immoral. But here's the truth they couldn't accept. We didn't break the Bank of England. They broke themselves by defending an indefensible position. We just recognized it before they did. This brings me to something crucial. I don't predict the future. I recognize patterns. There's a massive difference. Prediction is saying this will happen. Pattern recognition is saying I've seen this before and here's how it usually ends. Every market bubble follows the same basic pattern. Initial growth based on something real, then acceleration based on excitement, then a final blow-off stage where everyone knows it's crazy but nobody wants to miss out, then collapse. I saw this pattern in the conglomerate boom. I saw it in the dot-com bubble. I saw it in the housing market before 2008. I'm not smarter than other investors, but I've trained myself to recognize when we're in the excitement phase versus when we're in the blow-off phase, and I've learned that the best opportunities come when everyone is convinced the old rules don't apply anymore. When someone tells you this time is different, pay attention. Sometimes it is different, but usually it's just another loop accelerating away from reality, waiting to snap back. Let me distill this into principles you can actually use. First, embrace fallibility. Your ability to make good decisions doesn't come from being right. It comes from recognizing quickly when you're wrong and adapting. Build this into your process from the start. Second, look for feedback loops. When you see a trend feeding on itself, prices going up because prices are going up, or fear creating more fear, ask yourself, what's sustaining this? Is it based on fundamentals or just momentum? Momentum always breaks eventually. Third, watch for denial. The biggest opportunities come when reality and perception have split apart, but powerful people are still defending the perception. When leaders start making confident statements that contradict obvious evidence, pay attention. Fourth, position size matters. Even with high conviction, I never bet everything on one trade. The world is unpredictable. Black swans happen. The goal isn't to be right once with everything, it's to be right more than you're wrong and survive your mistakes. And finally, markets are about people, not numbers. The numbers just reflect what people believe and feel. Understand the psychology, understand the incentives, and you'll understand where the market is actually going. Remember that moment I described at the beginning, sitting in my office, feeling nothing when we made $1 billion. That's the goal, not the money, the clarity, the ability to see what's happening without emotion clouding your judgment. That trade worked because every step was methodical. Recognize the pattern, test the hypothesis, watch for confirmation, build the position, execute when certainty arrives. No drama, no gambling, just clear thinking translated into action. The framework I've described, reflexivity, fallibility, pattern recognition, it took me decades to develop, but you don't need decades to start applying it. Start small, pick one investment, one decision you're considering, write down what would prove you wrong, look for feedback loops, check your emotional attachment to being right. The best investors aren't the ones who never make mistakes. They're the ones who learn from every trade, including the successful ones. If this changed how you think about decision making, I'd be curious what resonated most. Leave a comment below, and remember, in markets and in life, clarity is worth more than confidence.